Hello, everyone. Welcome to the final bar. Today, we'll sit down with Dana Lyons from J. Lyons Fund Management. We'll talk about the overall market environment, some of the charts top of mind as we're looking at this overall sort of continued rotational feel. The S&P in a choppy trend for much of the day, remaining above yesterday's close, but not really gaining any upside ground. Materials, the big winner today, which I don't think there are many times so far in the last year or so when that's how I've introduced the show. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment using the power of StockCharts, using data visualization techniques, the technical analysis toolkit to tease out the messages that the markets are providing back to us, looking at messages of price and breadth and sentiment, trend and momentum to understand or gauge where trends are or where funds are flowing and try to anticipate inflection points, and most importantly, follow the trends. I found so many times we get caught up in particular narratives on what could happen or should happen. I was taught early in my career that price is what actually has happened. You can't restate the price, as my mentor, Ralph Acampora, one of my mentors, used to mentioned very often. So by analyzing price, there's information embedded in price itself. It tells you what investors are thinking, what they're feeling really, and what their emotional state is. And when they're excited or nervous or desperate or euphoric, all of that arguably reflected in price. And we're looking at the price of assets, risk assets over the last couple days. Yesterday, sort of a big move to the upside with the S&P gaining plenty of ground, getting back above 4,700. Today, more of a choppy sideways day. Think of today as sort of a digestion day. You had your big meal yesterday, and now we're sort of holding, in a holding pattern, sort of digesting that to see where we go next. Now, we have great guests on the show. I'm excited to talk to Dana Lyons. He always does a great job coming on the show and bringing sort of a money management perspective to what's sensible or what makes sense to follow. Tomorrow, we have Mary Ellen McGonigal from MEM Investments joining us once again on the show. Then a number of special events we have. All really the month of January is looking forward. We have Martin Pring sitting down with Bruce Frazier. That's actually airing tomorrow on January 13th at 4 p.m. Eastern. Our special 2022 market outlook called Charting Forward 2022 is happening next Tuesday on January 18th. You can go to stockcharts.com/2022 market outlook to get more information on all the great presenters: Tony Dwyer, Gina Martin Adams, John Markman, Linda Rashke. It's going to be a really cool set of insights from some really knowledgeable experts. Also, I will be doing a special virtual conference for the Money Show tomorrow called 7 Questions to Ask Before Every Trade. That airs around noon Eastern, if I remember. I think it's 12:10 Eastern. If you go to stockcharts.com/money show, you can sign up for that event. Also, just to let you know, I'm off this Friday. We're taking a trip to visit some family out of town. And so Aaron Swenlin from Decision Point has graciously agreed to host the show. So the show will go on Friday. Good Friday show is a great one because it helps you wrap the week, make sense of things over the last 5 trading days. Aaron is very well equipped to take the helm for that show. So she will be hosting the show this coming Friday. Let's continue on with our market recap. So as I mentioned, I could sort of describe today as a digestion day. And when I say that usually, after you have a big move, it's reasonable that you have a bit of a consolidation period, sort of the big move has happened. And now investors are sort of figuring out if that was the beginning of something a little more significant, whether it was an up move or a down move, but it's basically just a way to reset, sort of get back to an equilibrium. And then the market and investors determine where things are headed next. So today, sort of a choppy first hour and a half of trading. And from there, we settled in and essentially range bound for the day with the S&P closing just about 47.25. It's about 0.25% higher than when we talked yesterday after the close on Tuesday's session. Mid caps and small caps both down, and that chart of small cap underperformance is kind of an interesting one. It's interesting to me, given the strength that you've seen in some of the cyclical sectors, that small caps are really not participating as much as you might expect. Relative strength in small caps is actually moving lower, and days like today sort of accentuate that trend that we've seen coming into today's session. The VIX continue to push a little bit lower, now below 18, around 1770. Quickly looking at other asset classes, long bond yields were essentially flat from yesterday. 10-year yields coming off a bit, 5 years as well. So 10-year yields settled in around 172, 173. So a little bit below where we're at yesterday. And again, got above 180 a couple of days ago, which was fairly significant. That's the highest level we've seen in over a year. We're now sort of still within that range, the upper end of the range that we saw in 2021. Dollar index actually fairly significantly weaker. I guess it's not that big of a move, but by dollar standards, the UUP really doesn't tend to move that much day to day, I would say. It's usually a little bit lesser, but coming off a bit. Overall, that trend of the stronger dollar has been a significant tailwind to U.S. outperformance or a headwind for non-U.S. performance. Yesterday on the show, if you missed it, we talked with my guest there about the potential for dollar weakness and what that might mean for things as you're looking at those with Bill Baruch from Blue Line Futures. Good discussion. If you missed it, go to stockchartstv.com or on demand platform. You can check out that interview. Gold, precious metals higher today. Gold about 0.25% using the GLD. Silver up fairly well as well. The energy complex up pretty good with natural gas prices rising fairly significantly. The XLE is about sort of middle of the road when you look at the 11 S&P sectors. Where you're continuing to see upside follow through is in cryptocurrencies. If you think of cryptos as more of a pure risk asset, and I'm not sure how I would describe it. I don't know if that's how I would describe it, but it's closer to that than a risk off asset for sure, because you're seeing in general, when I think in general, on average, when I've seen stocks sell off, you see cryptocurrencies come off as well. It's really more of a gauge of speculation than anything. And you can see green across the board on the 10 most liquid coins that we track on StockCharts. We have about 160, 170 cryptocurrencies on StockCharts.com. We're adding more. If there are any you think we're missing that you'd like us to add, make sure you ping our support desk and we'll take a look and see if we can get the data up and running for you. But Bitcoin up about 3% from yesterday. Ether up just over 4% from yesterday, bouncing off of that 3,000 level not too long ago. Bitcoin getting down to 40,000 and now up almost 10% since bouncing off that level. Let's look at a couple other charts here, big picture, before we take a quick break. When I'm looking at the S&P 500, we've talked about some of these levels a number of times, and I don't, hopefully the chart of the S&P shouldn't change that often in terms of the key levels you're looking at. When I look at the S&P, a couple of themes come to mind. Number one, these shaded areas, I think, are becoming fairly significant in the last couple of months. 4,700, which is the level we're currently essentially rotating around. If you look at the last month, we've sort of been mean reverting right around 4,700 as a midpoint to that. That started as resistance in November and December. And now, again, the question is, can we get above 47 and hold? And I think that's a key question to ask going into the remainder of this week and into next week for sure. 4550, I would say, is sort of the most important level. That's the pink shaded area. That was the high in September. That was the low in December a couple times. If we would get down to there, that's where you'd sort of naturally expect some support, because that has been tested as support before. It also is demonstrating the technical concept of polarity, which is where resistance becomes support. So a level is established and then it continues to be meaningful for the markets. I put a video on my YouTube channel end of last week on the polarity concept, particularly with this chart of the S&P. So go to my Market Misbehavior YouTube channel. If you missed it, worth watching it to understand a little more about why 4550, I think, is literally a pivotal level for stocks. The other key theme, two others on the S&P chart, as I'm hitting this pretty hard today. The next one is the 50-day moving average. Most of 2021, the trading plan for the S&P was fairly straightforward. It turns out, with 2020 hindsight, all you need to do is wait for the S&P to hit the 50-day moving average, even just touch it, And overall, those tend to be pretty good entry points. That worked exceptionally well, except for one exception in September. Mid-September, you broke below the 50-day and really got the furthest below it that we achieved. Overall, a 6% drop from the all-time high in early September. But then again, pretty soon after, got back above the 50-day, and that was part of that indication, the all-clear sign showing that stocks were most likely going higher. But you also have this issue with momentum, right? The last couple times, the S&P has tried to make new highs here in mid-December, then here in late December, early January, you can see that the momentum picture is a little less positive. In general, in a classic bull market phase, you like to see the price become overbought, the RSI become overbought on the pushes higher, because that indicates a lot of upside momentum. You're not getting that. You're seeing the RSI fail around 60, which is actually more characteristic of bear market phases. But all of that, I think, is just more of a leading indicator, potential red flag. Holding above support is the most bullish thing that a market can do. And I think holding 4,700, holding 4,550, if that would fail, would most likely be a key level to watch. Just to wrap up our market recap, when I'm looking at sectors, I'm seeing materials at the top of the list, which is a little unusual. It's not often that we've seen materials up there. It's been sort of energy, it's been financials, it's been growthy stuff like technology and consumer, but rarely the materials sector. Might be an interesting place to look opportunistically if you've not been spending any time focusing there. On the downside, you have healthcare, which is really the only S&P sector out of the 11 that was down today, about 1/3%. Consumer staples were flat. And a little later in today's show, we're going to do a segment called Sector Deep Dive. We're going to dig into consumer staples in a little more detail. Last week, when I screened for stocks making new highs, probably the most consumer staples names I've seen in quite a while. Beverages names, food retailers, food producers. And we'll go through some of those charts and understand why consumer staples are setting up pretty well and what particular levels to look for. Let's take a quick break. We'll be back with today's guest, Dana Lyons. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's great to have you join us every weekday after the close, and we appreciate you tuning in and hearing our great guest interviews and the content that we're able to share with you. We're going to get to our guest today, Dana Lyons, here in a few moments. Before we go there, I wanted to remind you, your questions are very much welcome, particularly as you are running into your own issues, analyzing charts, using the StockCharts platform, using particular technical indicators or approaches, whatever you're looking at. We are happy to try to help address any challenges you're facing. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our Stock Charts channel. We'll hope to hear from you very soon, and we'll answer your questions in our next mailbag segment. Also, as I mentioned earlier today, go to StockChartsTV.com. That's our on-demand platform. We have so much great content every trading day. Even some weekends, we'll do some special events, but there's so much. If you're struggling to make sense of these markets in challenging, uncertain times with so many potential narratives and future directions, our experts are here to help you make sense of things. Go to StockChartsTV.com, or on your mobile device, just search on any of the app stores for StockCharts TV on demand. I want to welcome on today's guest, Dana Lyons. Dana is a partner at J. Lyons Fund Management. He's the editor of the Lyons Share Reports. It's such a great job of giving sort of a behind-the-scenes look of the things that, from a money management perspective, that Dana and his team are looking at as they are trying to outperform in these current markets. Dana, welcome back to the show. Thanks for joining us.
Thanks, Dave. Always a pleasure being on.
You always bring such great long-term charts, and I'm so thankful for that. It's a great reminder to sort of back away from the flickering ticks of the market and pay attention to the long-term. You're starting us with a bit of a look at breadth. Talk us through this chart of the S&P 500, if you could.
Sure, Dave. And you mentioned earlier how important price is. Obviously, price is the most important thing, and you've heard the term price is truth. Mm-hmm. Well, we consider breadth to be just about as important as price. And in fact, I kind of look at breadth as sort of a lie detector on price. So what we want to see is breadth, or the broad market, a strong level of participation among the broad market of stocks supporting a move. So, for example, when the S&P 500 hits a new high, we want to see broad participation among all the stocks in the market. when that happens, then that's supportive of the move and confirms the move. When we see new highs that are not supported by a large, good participation in breadth, then our risk antenna goes up and suggests to us that that breakout or that move is much less likely to be sustained. It doesn't have to fail right away, but it's less likely to be sustainable if it doesn't have, the broad support of the underlying market. So we've seen that at some of the more recent new highs in the S&P, where we've seen a proliferation of new 52-week lows on the NYSE. And obviously in the past, based on this chart, when we've seen these types of instances, it's had negative ramifications on a longer term, intermediate to longer term basis. So that's one thing that has that's a red flag for us right here.
It's so interesting how I feel like you mentioned, I love that phrase, by the way, breadth is the lie detector for price. We've had this situation. If you look at 2021, it appears, looking at the S&P 500, is the most orderly, consistent uptrend in history. But, breadth tells you a bit of a different picture, right? In terms of the activity of some of the individual names that comprise those indexes. Switching gears a bit to cryptocurrencies, there's been a lot of attention to Bitcoin, Ethereum, and others that have had pretty significant drawdowns from all-time highs, in 2021. What are you seeing here with Ethereum?
Sure, this is more of a kind of practical trade setup chart. So we typically like to follow the trends and buy the relative strength. At times, we will, catch the falling knife, as it were. It's got to be at significant mean reversion type levels, though. And for us, those would be like major Fibonacci retracement levels, and preferably at a confluence of Fibonacci levels. So in this case, Ethereum the other day, right around 3,000, was testing that 38.2 retracement from the 2018 low, as well as that 61 retracement from the lows of last summer. So when we see prices test those two most important Fibonacci retracement levels, that gives us high confidence that at least we're going to see some sort of a bounce, if not the start of a longer term reversal.
Now, one of the big challenges, I think, in 2021, Dana, was that rotational environment, right? Where you had value working, you had growth working. It sort of felt like we were whipped around a number of times. What are you seeing now in the value space? Is this a good opportunity here?
That's right. It's an interesting question because we did see constant rotation last year. And in terms of growth versus value, growth has been leading literally for like 15 years. And we've seen a lot of whiplashes and head fakes by value. I can count like a half a dozen over the last 2 years where value has had a little head fake that has proven to be not sustainable. In this case, we're seeing another move here to start the year where value is on a relative basis is making a move against growth. Here on an absolute basis is a ETF called the S&P 500 Pure Value. So this strips out any growth type stocks whatsoever. This is pure value, and whether we're seeing a relative long-term shift towards value remains to be seen. But on an absolute basis, if you want to trade value, this is a good representative, as we're seeing a breakout just over the last few weeks to all-time highs. And you have at near that breakout point, or that launch point, at least on a pullback, a very good entry point into RPV.
It's a great chart. It shows the strength and value. I think the question, of course, is the relative strength, right? Is what the value is in owning value, pun intended, versus other areas of the market. Just with a minute that we have left in, and when you're thinking about this current market environment, a bit of a pullback here to start January, but overall, we have a bunch of competing narratives through the course of the year, particularly, obviously, the Fed, the prospect of higher rates and what that means. When you're looking now, if you had new money to work, where are you looking opportunistically? Is it in value areas of the market, places like energy and others that, financials that have already, jumped a bit from where they were? Or is it some of the growth names that are pulling back all potentially to some viable levels? Where are you looking?
We're looking across the board. You have some of those growth names like tech, and at least areas in tech like semiconductors that have pulled back but are still in pretty constructive technical positions. that are testing pretty good entry points. So you can spread some money there. You have a very close nearby stop loss. At the same time, you have the emergence of value like the energy sector, financials that have broken out. And while you don't have to go out and chase them, today or tomorrow, you have a new breakouts and you have good kind of the other end of the spectrum, the other end of the barbell, where if you have pullbacks in the value space, you have good spots to buy those areas as well. So like you said, I think that the important thing is to concentrate on price and maintain those positions in strong acting areas. And when they break down, like we've seen in some of the tech areas, like we saw in the broad market in November, then you have to pull the trigger, especially with the underlying breadth conditions that we're seeing.
Great points all around, Dana. And listen, it's awesome to have you back on the show. Happy New Year. Thanks for coming on, and we'll look forward to talking to you again soon.
Sounds great. Thanks a lot, Dave.
That's Dana Lyons. Dana's a partner at J. Lyons Fund Management. He's also the editor of the Lyons Share Report. And again, I'm talking with Dana reminds me of some of my favorite discussions, working in the institutional buy side and at a money management firm, and talking to people who are actually trying to answer these questions of the markets, thinking about where to allocate, thinking about how to manage risk. So much to gain from the expertise of people like Dana and others. So really appreciate Dana Lyons joining us today. Let's continue on with our next segment called Sector Deep Dive. So what we'd love to do with some regularity is take one particular sector. A lot of times on the show, we sort of glance around and we kind of go anywhere. We go where the movements are, but I like to take a step back and focus on particular sectors and just think about what they might represent and how to break them down potentially from a technical perspective. One of the things we were looking at what sectors we'd covered. I don't think we've covered consumer staples in one of these. And given some of the strength that we've seen in staples, I thought it'd be interesting. Now, consumer staples, I mean, we mostly talk about consumer staples in ratio form because we often look at what I call the offense versus defense ratio. And I'll bring up that charter pretty quick. That's basically, offense is sort of consumer discretionary, defense is consumer staples. And the reason why that is, basically you're looking at consumer discretionary things you want versus consumer staples, things you need. When investors are going more risk on, we go into more, leisure items, discretionary items you don't necessarily need, but are kind of good to have. And you splurge on purchases. When things are getting more defensive, when things are getting more negative, you still need toilet paper and arguably tobacco or alcohol or whatever it is that you need, household products, cleaning supplies. And so as a result, consumer staples tend to do better when consumers are getting a little more protective and when the markets are getting more defensive. You can see with these red sort of parabolic shaped annotations how these ratios have turned. And going to mid-November, it was a clear indication of offense over defense. Now we're seeing the opposite. We're seeing defense start to win over offense. Now you're getting a bit of a bounce here this week in a day like today where discretionary is outperforming staples is going to cause us yesterday certainly a bounce a little bit to the upside, but overall the trend has certainly changed. At the very least, it's consolidating here. So what is that doing? How is that actually being reflected in the individual stocks? Here's what I would tell you. Anytime you want to do a deep dive, and again, we call this segment Sector Deep Dive. It's only about 5 minutes we have to dedicate to this. There's only so deep we can go in limited amount of time. But what I want to do is just encourage you to think this sort of way when you want to dig into a particular sector and understand a little more deeply. The page I like to use for this on StockCharts is called the Industry Summary page. If you go to Charts and Tools in the upper left, or go to the list in the upper left corner of your dashboard, you'll find the Industry Summary. This has a chart view where you can flick through some of the different industry groups. I like to use the table view because then you can resort it on some of these different metrics. And if you go, it's alphabetically by sector, and then it shows you the industry groups that we have allocated to those different sectors. And you can sort this on different on any of the different columns. I like to sort it by the Scooter ranking, which is a systematic trend following model that ranks any universe. In this case, it's ranking 106 industry groups from the strongest positive trends to the to the weakest trends, from 99 to first percentile, and it allows you to compare on an apples to apples basis a number of different industry groups across sectors. So what you can see when you look at the top of the list here, the group that is, in over time, over this longer term time frame that the Scooter rankings are really built on, food retailers and wholesalers are the top ranked are the top ranked group. You compare that to Brewers, which would be like Molson Coors and Sam Adams and those kind of things, down one of the worst ranked groups across all of them. You can click into there to look at the individual stocks and see some of the different names. So within one of these particular groups, you can rank them based on a particular rating. You can sort of make sense of that list of names. So I clicked on food retailers, which is the top ranked group. What I'm now doing is sorting it by scooter rankings. And this column right here can be really helpful because it tells you the market cap. It's just a general placeholder, mid, large, small, gives you a sense of how big some of these companies are. You can go through there and look at the individual names, or you can use the mouse and sort of do a quick little preview. What's interesting, we'll look at Tesco. If you're based in the U.S., if you've ever been to the United Kingdom, you probably ran into a Tesco. It's a pretty popular grocery chain there. And look at how consistent this trend is. Now that you're looking at an ADR here, this is TSCDY, so it's an ADR of a UK listed company. But you can see this nice basing pattern in the first half of 2021 really broke out to the upside, and now it's been a fairly consistent uptrend. Now this is at a time when a lot of consumer staple stocks were actually struggling quite a bit. This is a name that actually did well. And what's really interesting on this chart is the relative strength, which over the last 6 months has been fairly constructive. These are some of the types of charts that you'll find in that group, food retailers and others. And I'd encourage you, especially when you're thinking about a sector like consumer staples, how do I want to get exposure? You can kind of go in there and see where they're at. I did want to jump around just for a couple seconds. I also like to use the scanning engine, look for top ranked names in a particular sector and see what comes up. So here I actually look for scooter rankings above 80 across the whole consumer staples sector. And I think this might be S&P members. I actually don't think I filtered it to that. That doesn't make sense because some of these aren't S&P names. I think this is just a market cap above 10 billion US. And that's it. So you can obviously change these parameters to see what you find. But 6 stocks in the consumer staples sector with a market cap above 10 billion that have a scooter ranking above 80. And they're really only in 2 particular groups. Food retailers, and I mentioned Tesco. There's also Albertsons, ACI, which is a US-based grocery store. And then you have 4 within food products. Some of these names we've talked about, others maybe not. Let's go through those 6 charts very quickly. ADM, Archer-Daniels-Midland, is in food products. What I love about this chart is almost a cup and handle like pattern. An ideal cup and handle pattern would have a really consistent base, a really consistent resistance level. This is pretty close. I think close enough to sort of give it the nod. But you see this big rounded bottom pattern after a big uptrend, and then we broke above that shorter pullback, and then we broke above the resistance around 67.50. It remains above there, and overall, that's a fairly constructive chart. BG is a name we've talked about with another sort of cup and handle like pattern breaking above previous resistance. Nice follow through so far today. JBS is actually it's a Brazilian company, if I remember right, food products company. They have beef and some other things. Overall, sort of consolidating, but overall the trend has been fairly positive. Tyson, TSN, is a fairly constructive chart. So some of these charts, it's funny when you look at them, you may not think they're in consumer staples because you think of that as a fairly defensive group that has probably not been performing well. But I'm finding pockets of groups that are stocks that are doing very well. Also, things that didn't show up on the scans, things like Church, Dwight, CHD, and others recently breaking out of previous resistance. So look for stocks making new swing highs, highly rated scooter names within this sector. You can probably find some good opportunities. We need to wrap the show. Go to the 3 and 3 charts, 3 minutes. Here we go. Chart number 1 is the small cap versus large cap ratio. This is part of my Mindful Investor live chart list. I have a series of ratios that I go through. We try to get to every Friday on the show. This ratio continues to go lower. It's a bit of a head scratcher given the fact that the cyclical sectors have done pretty well, right? Energy stocks at or near all-time highs. A lot of financial names at or near all-time highs, but the small cap benchmark, the Russell 2000, continues to underperform. It's an interesting one. And even today, right, you had the S&P higher and mid caps and small caps down as well. Apparently, the return of small caps, which we talked about in November, never really materialized. Until that turns higher, it's telling you to it pays to stay large. I was talking with my friend David Sato-Chung from IBD yesterday morning, and we went through this chart of crude oil. It's a bit misleading because when we include the last 2 years, we're seeing this bombed out crude oil prices when the futures went negative and all sorts of craziness in the first half of 2020, but overall sort of at near highs there. Also, the financial sector, if rates are going higher, if the yield curve is steepening today, not necessarily, but overall, that has been the broader trend. The financial sector should be doing pretty well. One of the few sectors, energy and financial, so far making new all-time highs this week. Folks, that is our show. Thank you so much for joining us every weekday after the close for the Final Bar. Special thank you to Dana Lyons from J. Lyons Fund Management. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.